Welcome back to Options Trading for Beginners. In our last few videos, we've covered the core building blocks of options, from the option premium to the breakdown of intrinsic and time value. Today, we're going to talk about what is arguably the most dynamic and critical factor in options trading: volatility. In simple terms, volatility is a measure of how much an asset's price moves up or down. Stock that swings widely in price is considered highly volatile, while a stock that remains stable is considered to have low volatility. This concept is a key driver of an options premium because an options value is directly tied to the potential for a price move. We break this down into two main types: historical volatility and implied volatility. Historical volatility measures how much an asset's price has moved in the past. It's a look in the rearview mirror, calculated using a stock's past price movements over a specific period. It can tell you how volatile a stock has been. Implied volatility is a forward-looking measure that represents the market's expectation of future price swings. Think of it as the market's own forecast for future price movement, similar to how a weather forecast predicts the storm's intensity. So while historical volatility on its own doesn't predict the future, it's a crucial benchmark. By comparing the current implied volatility to a stock's historical volatility, a trader can get a sense of whether the options are currently considered cheap or expensive relative to their past behavior. Implied volatility is called implied because it is not a directly observed historical fact. Instead, it's the level of volatility that is implied by the current market price of the option itself. It's a process of reverse engineering using an options pricing model like the Black-Scholes model. All the factors that determine an options price are known, so we use the option's actual market price to solve for the level of volatility that must be present to justify that price. It's important to remember that a single stock does not have a single IV. Instead, implied volatility is specific to each individual option contract and can vary by both strike price and expiration date. We'll see exactly how this is laid out in the options chain in our next video. This concept is so crucial because a high implied volatility means options are more expensive because the market is pricing in a higher probability of a significant move. Low implied volatility means options are cheaper because the market expects the underlying asset to remain relatively stable. Let's use an extended example to illustrate this with a concept known as volatility crush. Imagine a small biotech company, Biotech Inc., is about to announce the results of a crucial drug trial. In the days leading up to the announcement, the uncertainty and high market expectations caused the implied volatility for Biotech Inc. options to spike. Traders, anticipating a big move, are willing to pay a much higher premium for these contracts. The premium is inflated by this high IV. The day after the announcement, regardless of whether the news was good or bad, the uncertainty is resolved. The implied volatility, and with it a significant portion of the options premium, will often crash. This is a phenomenon known as volatility crush, and it can cause an options value to drop dramatically, even if the stock price moves in the direction you predicted. This is a major risk for option buyers. Understanding this dynamic is crucial for every options trader. It's what separates successful traders from those who simply gamble. Traders buying options, you generally want to do so when implied volatility is low, as the options will be cheaper and a subsequent increase in IV can boost your profits. For those selling options, you want to sell when IV is high to collect a larger premium, which then shrinks after the uncertainty is resolved. In the next video, we'll put this knowledge to practical use by showing you exactly where to find and interpret implied volatility on a real trading platform. We'll take a deep dive into the options chain, a central tool for options traders and show you how to navigate the data to find the right options for your strategy. Don't forget to like and subscribe so you don't miss the rest of the series. I'll see you then.